All right, so I see the SONOMA already put up there on the screen. So
Yep.
once again, welcome, Sam, to at least virtually to Frankfurt, and great to have you here. We're looking forward to your presentation. I'll signal time to you. Please go ahead.
All right, well, it's great to be here. And of course, thank you to the organizers for including our paper. And then thank you all for attending this session. So given that my co-author is at the Federal Reserve Board, I must give the following disclaimer. But now with that out of the way, let's go ahead and get started. So in reality, small open economies feature both internal and external liabilities. So we're going to include both in our framework. And we seek to understand the role of internal versus external credit shocks. And specifically, we investigate how these shocks affect the riskiness of financial assets. And we also want to understand how these shocks spill over to the real economy. So the objective of this study is to produce a quantitative macrofinance model for small open economies. And by macrofinance model, we mean one that's able to match key moments on both the real and financial sides of the economy. So why do we care about matching financial or asset pricing moments? Well, by matching these moments, we are capturing the difficulties in substituting across financing sources, which have real effects on economic activity. It's an empirical fact that different sources of financing have different costs, meaning they're not perfect substitutes. And so in our model, we're going to rationalize this fact with financial frictions. Now, ultimately, we believe our model is well suited for policy analysis. This project was motivated originally by the recent experience in Europe, where we see that even after 10 years, many small and mid-sized economies are still dealing with the aftermath of the Great Recession. So these countries were first affected by the US financial crisis and then later by sovereign debt concerns. So now let me tell you about our contribution and findings. So we develop our model in 2 steps. First, we take the closed economy model of Emanuel and Quadrini, and then we augment it with Epstein-Zinn recursive preferences and growth. Now, in a model with permanent shocks to levels, income and substitution effects can produce counterfactual results. That's not the case here, and we consider this an accomplishment per se. Next, we open up this closed economy by introducing external credit markets, and thus we have our SONOMA model. So our findings with this model are as follows. First, this model is quantitatively powerful in its ability to match key data moments for small open economies, both on the real and financial sides of the economy. Now remember that, as I said before, matching asset pricing moments is important because it means that our model captures the cost associated with substituting across different sources of financing. So in the literature, there's a debate about the relevance of financial shocks, and we contribute to this debate with the following results. So internal credit shocks become less contractionary in a small open economy. Why? Well, agents are able to borrow from abroad to offset part of the disruptive effect of the domestic shock. However, the ability to borrow from abroad also has a cost in terms of exposure to external credit shocks. And we find that these shocks are as contractionary as the internal ones. Now, taken together, we find that financial shocks as a whole are of first order importance. Now, last but not least, we have an empirical contribution through the following findings. In a VAR analysis, we find that internal and external credit shocks are correlated. So this means that credit shocks are difficult to hedge. And we also find that external credit shocks are leading indicators of sluggish long-term growth. So when there's an adverse external credit shock, expected long-term growth declines. Now, moreover, external credit conditions and expected long-term growth are actually co-skewed. So this means that the relatively bad external credit shocks are associated to relatively large declines in expected growth. And to the best of our knowledge, this is the first study documenting this empirical fact. Now, as a whole, these empirical results provide further evidence on the importance and nature of financial shocks, and we are continuing to develop our empirical analysis as we build upon our harmonized small open economy data set. And I'll have a few things to say about this at the end of the presentation. So we are aware that we relate to a substantial literature, but let me skip ahead and let's just jump straight to the model. So the household has Epstein-Zinn recursive preferences where risk aversion and IES are captured by gamma and psi. The budget constraint is standard for the small open economy literature, but let me go over it just for clarity to cover the important terms. So the household earns labor income. The household owns equity in domestic firm, and this term represents the net equity payout. The household also lends to the domestic firm, and this term represents the net debt payout. So X is the level of net external debt that the household has with the rest of the world. So this term as a whole represents net additional borrowing, which is the negative of the change in their net foreign asset position. Now let me tell you about this external cost of capital, R. So R, it's the sum of an exogenous component RW and an endogenous component P. We model the exogenous component RW, as in Neumeyer and Perry. Importantly, it captures both movements to the world interest rate and any changes to country-specific factors not captured by external debt balances. The endogenous component P is an increasing function of a country's external debt. P is a reduced form way to think about country default risk. So the functional form for P is from Schmidt, Groh, and Uribe, among others. And as part of our calibration, we do estimate the parameters of this P function, but I won't have time to discuss this exercise today. Now, if we want to close this economy, it's relatively easy to do. We simply replace this external interest rate equation with one that sets debt to 0 in every period. This is an experiment that that we'll return to in our results section. Now, finally, there's no default in this model. So in equilibrium, the domestic borrowing rate and external rates are equal. This equilibrium condition is important because it's the channel through which external credit conditions affect the domestic corporate sector. Speaking of domestic corporate sector, the private firm makes labor, investment, and financing decisions. In the budget constraint, we see that the firm's net equity payout, little d, is equal to its output, less wages, less investment, equity issuance cost, net debt payout, and taxes. So there's a corporate tax that incentivizes the firm to issue debt in order to take advantage of its interest rate tax shield. However, the firm is limited in its ability to issue debt because of a collateral constraint. So we use the same collateral constraint as in Ehrman Quadrini 2012. And this constraint effectively pins down the level of debt. Now, domestic credit shocks are shocks to this financial constraint parameter, XI. And we interpret the level of XI as a measure of domestic financial conditions. So an adverse shock would make this constraint tighter, and then all else equal, the firm either needs to cut labor and investment or issue equity. Now, from this perspective, it's crucial that we also include these equity issuance costs, which are represented by this chi function. And this friction gives a real bite to financial shocks because firms cannot freely issue equity to offset credit shocks. So without it, there would be no real impact from financial shocks. The exogenous processes in this model are standard. Market clearing is also standard. So there are two key insights from the first order conditions I want to highlight. First off, Epstein-Zimmer recursive preferences make investors care about long-run shocks. So this is standard in the long-run risk literature, and the key term in the SDF is highlighted in red. Second, as in Ehrman and Quadrini, we see that financial constraint causes a wedge in the labor market. As a result, an adverse shock to internal credit conditions will cause labor demand to decline. As in Ehrman and Quadrini, this is the main channel through which the domestic financial friction has a real effect on the economy. So for our empirical investigation, we gather data on national aggregates, debt stocks, interest rates, returns. And although the individual sources are common in the international literature, they don't talk to each other, and we expended a significant effort to harmonize measures across them. So what do we do with this data? Well, we're working on a full estimation of the model. We're not there yet, so for now we take a shortcut. We take a subset of equations from the model, assume they hold perfectly, and then we use them for measurement. So specifically, we compute the following country-level measurements. And we do this for our sample of 10 European small advanced economies. What do we do with this measurement? Well, we run a VAR. So our panel of country-level measurements is unbalanced. So we're going to deal with this by taking a cross-sectional average. And you can think about this average like a representative small open economy. In the future, we do plan to explore cross-country heterogeneity in this VAR framework as well. So we run a simple VAR with only 3 variables. It's our measure of external credit conditions, internal credit conditions, and expected long-run productivity growth. So the goal here is to understand the correlation between our fundamental shocks. And keep in mind that we're working with a less well-known subset of countries, and thus we find it important to document the empirical properties of these shocks. So our key results are presented in the following table, but rather than going through the individual numbers, let me just highlight the key takeaways from this exercise. So what do we find? Well, first, internal financial conditions deteriorate in response to a bad shock to external credit conditions. So external and internal credit conditions are correlated, and the significance of this correlation is that credit shocks are difficult to hedge. Second, long-term expected growth declines in response to a bad shock to external credit conditions. So this means that deteriorating external credit conditions are an indicator of sluggish long-term growth. Now finally, we find that the co-skewness between external credit conditions and expected long-term growth is positive. And so what this means is that a relatively bad external credit shock is associated to a relatively large declines in expected growth. To the best of our knowledge, this is the first study documenting this empirical fact. All right, so our calibration is done in the spirit of the past literature, as well as our novel empirical data and results. And in order to understand the mechanisms and dynamics of the model, we're going to do a few experiments. So the first one is we close the economy. And as discussed earlier, this can be done simply by replacing one model equation. And we also are going to examine the impact of removing financial frictions, which we can do in a few different ways. Okay, so this table shows key moments of the model, starting with the replication of Ullmann and Quadrini, and then progressing towards the closed version of SONOMA. And the middle column represents an intermediate calibration. So the top portion of this table refers to average levels of macroeconomic variables. The middle portion refers to volatilities of macroeconomic aggregates. And the bottom part comprises asset pricing moments. So the key takeaway from this table are the numbers highlighted in red, which show that the Ullmann and Quadrini model deliver an equity premium close to 0. Closed SONOMA, however, delivers an equity premium of over 4% per year. Now, the fact that we're able to retain the success of Ullmann and Quadrini while improving the asset pricing performance is part of our contribution per se. So this table highlights the performance of our SONOMA model. The layout is similar to the previous table, except the columns have changed. So the data column shows the cross-country medians for our sample of small open economies. The range is essentially the 20th to 80th percentile values. The open column is SONOMA, and then the closed column is the closed version of SONOMA, which we saw in the last slide. So on the plus side, in the open economy setting, we match the volatility of external balances, of the external liabilities. And we also match the mean and volatility of the country minus world interest rate spread. We also generate a large equity premium of over 4% per year. Now, on the downside, the model suffers from the well-known problem that excess returns are too smooth, not excessive, and hence our equity risk premium is not driven by an implausible amount of financial leverage. All right, so in this figure, we show impulse responses to adverse shocks to productivity, internal credit conditions, and external credit conditions. So I know there's a lot of panels and it's overwhelming. So let me just skip the figure itself and let's just go straight to the key takeaways. So what do we learn from studying the impulse responses? Well, in the open economy setting, we find that responses to internal credit shocks are weaker. And this is because the household is able to borrow from abroad to offset the disruptive impact of the internal credit shock. We also observe that the external credit shocks are as powerful as internal credit shocks for several key variables such as consumption and investment. However, the response of the net foreign asset position is the opposite for external versus internal credit shocks, which is good news for us as it will be useful for identification when we move to our structural estimation. Finally, we can deduce that both types of credit shocks contribute to the equity premium according to their effects on the SDF and excess returns. So in this table, we report the results of the experiments in which we remove financial frictions one at a time. Now, I recognize
10.
10, thank you. I recognize that there are a lot of columns, a lot of numbers. So once again, let me skip the table itself and let's just focus on the key takeaways that we would get. So what happens if we remove internal credit shocks? So we keep the collateral constraint. We observe many counterfactual moments, such as output volatility is too low and a reduced equity premium. And so these results confirm that domestic credit shocks themselves are relevant for economic activity as well as asset prices. Now, what if we remove all domestic financial frictions? So it's akin to moving to a Modigliani-Miller world in which capital structure does not matter. So here we find that the equity premium declines even further, and this result confirms that financial frictions are important too. So what if we remove external credit shocks? Well, we observe in particular that consumption and external balances become too smooth, and also that the equity premium declines. So similar to the first experiment, these results confirm that external credit shocks are relevant for economic activity and asset prices. And so that's really the main takeaway from this set of results. So in this slide, we show the results of an experiment in which we add co-skewness between external credit conditions and expected long-run growth to the model, as we observed in the data. Now, we accomplish this by modifying our exogenous processes to include a common tail event. And we set the parameters, these J parameters here, in order to obtain a co-skewness in the model of 0.37, which is consistent with our empirical findings. So what do we get from adding this common tail shock? Well, in small samples, most of our simulated moments change only slightly from the table that I showed you earlier. There are, however, three notable departures. First, the cost of equity increases. Second, there's a decline in the steady state level of capital, and specifically, this increase in the cost of capital reduces the steady state capital to productivity ratio by almost a percentage point. And in order to assess the economic relevance of this decline, we compute the welfare loss induced by this tail shock, and we find that the cost is equal to 16% of lifetime consumption. So the takeaway here is that our SONOMA model suggests that in small open economies with financial frictions, credit shocks can have strong detrimental effects because they are a leading indicator of a negative outlook about long-run growth. So in my last few minutes, I want to tell you about some exciting new things that are not yet in the paper. So one question we've recently been exploring is, are there relevant shocks in the external equity markets too? So this question is motivated by the fact that net foreign assets in reality are composed of both debt and equity. And as far as we know, the literature has not yet explored the composition of net foreign assets in a small open economy model. So in the remainder of this slide, I'll tell you about what we've done and found so far. So in the model, we add an external equity asset for the household to invest in. And you can think about it like a world equity ETF. Now, the key difference compared to the external debt is that this world ETF is exposed to two different shocks. There's a shock to the contemporaneous return of the ETF, as well as a shock to the expected return of the ETF. Now, we can measure the returns and estimate the parameters in these equations using data on external equity positions and returns to the world and country equity indexes. So far, we have found the following when we augment our model in this way. First, an adverse external credit shock is associated to a decline in the value of a country's net external equity position. Second, an adverse shock to the expected external cost of equity is associated to both the decline in internal credit conditions and slower expected growth. And third, external equity shocks are contractionary, sizable, and promote a consolidation of corporate leverage. Now, finally, we find that the model responses of external positions to these shocks are consistent with the data. So in our next step, beyond incorporating this additional margin into our framework, we plan to do a formal structural estimation of SONOMA with this expanded external equity market.
At 5.
Okay, well, you know, I think I guess a little bit ahead of schedule here.
That's fine.
Yeah, so to conclude, we develop a small open economy model in which external debt and corporate domestic debt and risky equities coexist, and we call this model SONOMA. It's a quantitatively powerful macrofinance model, and our current set of empirical and theoretical results highlight the interplay of financial frictions and the resolution of uncertainty. So thank you for your time, and I guess I'm a little bit early.
Thank you very much, Sam. No problem at all, as I said. And the discussant will be Alexander Meyer-Gohde from right here, very close to me, at least in normal times. So the floor is yours. 20 minutes. Thanks for taking over the discussion.
No, my pleasure. Okay. And thank you for the presentation, Sam. That was great and very interesting model. So I'm going to start off by just summarizing from my perspective what this paper does before I move on to some questions and ideas, some of which I see have already been taken up in the further extensions and work going on. So unfortunately, then some of those suggestions might not bring as much as I would have liked, but nonetheless, they are what they are. So the general idea here is to develop a small, right, but nonetheless open economy macrofinance model. It's key to emphasize here, at least from my perspective, that still it's a real economy. When we start thinking about potential implications for monetary policy, that's something to keep in mind, that we have to think think a little bit further abstractly in terms of how monetary policy might enter. But the basic idea from my perspective is to see how we can combine insights from closed economy macrofinance models that we're familiar with and financial frictions to generate here an open, small open economy model to allow us to address here some of these international finance puzzles. Again, here importantly then from a production-based approach, right? This is in terms of moving towards structurals, that's already a big leap in providing us here a production-based small open economy macrofinance model. So that's not to be underestimated. So the main results here, we have multiple shocks, right? Long and short run shocks, growth shocks, and they contribute here together to the fit in the context of global credit markets. And the empirical analysis that was done supports the conclusions. All right, so I'm going to go through the results in a little bit more in detail, try to poke at the mechanism, and then turn to questions and suggestions. All right, so it's a shotgun wedding of 3 people here. Right, we have Mendoza, German Quadrini and Croce model. Really, this open economy. We have financial frictions, and we have this long-run production-based perspective. So we have persistent credit shocks that are then going to be priced via recursive preferences. And I think that's important when you're talking about the results vis-a-vis German Quadrini. The key, even in the closed SONOMA model, from my perspective, correct me if I'm wrong, is going to be the departure from expected utility preferences and moving to the Epstein's in. Also here highlighted is that the advantage of being in this open economy is that you can ameliorate domestic credit shocks via foreign borrowing. So we have the opportunity to replace some of the losses that would come about in a purely closed economy, right? Trade is good. And here, access to multiple credit markets is also good. But we also have the foreign credit shocks induce deterioration of both domestic credit conditions and long-run growth. And this is an important result that I found very intriguing, that was done very convincingly in the empirical setup. And the point that I say here that I get to in terms of the structural model is that it's introduced mechanically, which is really what I'd like to see. Would have loved to see the mechanism that's going to explain structurally how foreign credit shocks transmit to domestic credit conditions and long-run growth within the economy. But beyond all that, this is measured, and this fact has been documented here, and that was for me new news and something very interesting to see. All right, laid out very well by Sam here. The structural model is in line with key macro and return moments. The few couple of exceptions are not surprising; they're pretty standard. So essentially, what this model does is it's expanded our ability to capture several now international financial and facts without having to pay a price in terms of what we're already able to match. So this has only increased our ability to match facts from the data. Okay, so the data-driven, the estimated, the empirical part of the paper works in a VAR, and we have here this world interest rate, our domestic credit conditions, and long-run growth. Went through with this several different small open economies. How small, right? Italy, Spain. I'm not from any European country. I'm an American, but I've been here in Germany. So fortunately, Germany wasn't in this list. Otherwise, I would have had to object very profusely. But nonetheless, so a broad set of countries. The choice of European countries sort of emphasizes the combined structural developed characteristics that I think is also important to make the connection to growth process convincing. You could think about some countries being within the monetary union, some without, some with fixed exchange rates, what consequences that might have. So how are these shocks then identified? It's done using here Cholesky identification. Fine. As a consequence here, mechanically, we have that it's a lower Cholesky, so the shocks to our external interest rate can affect internal credit tightness, which is this C or Z variable, and long-run productivity on impact. Right? And we see statistically significant negative responses right, along those lines. Also then here, this co-skewness, the correlation of downside risks, long-run growth, and external credit. So this was this empirical fact that was new to me and was great to see. Theoretical, the model, we already saw plenty of equations. As I said, it's this shotgun wedding is not nice. I think it's a very congenial wedding of these three models. We have a risk-sensitive household finances consumption, we have labor, and then we have net payouts from three different types of assets: equity, corporate debt, and foreign assets. Right? And this external debt position of the country is determining the spread above the exogenous world interest rate as Sam laid out. And this is a mechanism, like the vector Schmickel and Oribe, among others, right? So that's perfectly understandable and right, something we should all be familiar with. Firms on the capital stock face capital adjustment costs. We have long-run productivity risk. And then we have this tension. On the one hand, interest on debt is rebated, dividend payouts are costly, and we have a credit constraint. And these three things are given this interplay that makes then this right departure from Modigliani Miller important here. Okay, so the external financing shocks. We have the VAR, and when we take it in the model, we get this this set of three equations. Right now, what we notice here is that for the long-run growth process and for our internal the internal financing tightness or internal financing shock, the shock in the right, the credit constraint for firms, we have just mechanically here the shock from this rest of the world interest rate showing up here. Now, this was identified in the VAR, so I understand why it's there. I would like to know the structural mechanism that's giving me this link, right? In terms of if policy is going to do something effectively, how is this going to come in, right? One reason perhaps to object to this is that in the absence of these negative correlations, right, we end up seeing a wealth effect from the world interest rate. World interest rate goes up, right? Households are poor, start working harder, and this comes in. And so this doesn't seem to align, at least with my thinking of a small open economy that's dependent on external financing. So I understand why this has to go in there, but I'd like to see the link there. Also, just in general, the timing didn't seem to be exactly consistent with the VAR, because the VAR told us that shocks to the rest of the world interest rate affect C and X on impact. And here we have it with a 1-period lag. Is this important? Is this not important? I see this happen a lot in models where we, I'm not sure. And then here, a point that was emphasized, right? Remember, we have a lower Cholesky decomposition, so conceivably, shocks to internal financing conditions should affect long-run growth as well, right? And indeed, the authors note that they find a significant contemporaneous effect of these domestic credit shocks on expected productivity growth, but they abstract away from this channel, right? So I would wonder, what would happen to the estimates that you have in the VR study? Would they be affected if you impose this zero that you look at your model later? I mean, you have a statistically significant effect that you then ignore while defining everything else exogenously according to your estimates. Okay, so structural mechanism, I've mentioned that, right? If this setting is going to be used for complex policy analysis, especially when you start thinking about monetary policy, fiscal and trade policies, we got to find that structural mechanism behind these shocks. How is this correlation going to be affected by policy? Right now, I said, so yeah, first step, difficult. So it's difficult to flesh out what fiscal policy can do quantitatively. In monetary policy, right, we have no role for nominal variables here at all. It's not clear what they could do qualitatively or quantitatively. But as I said, and this is something I can't emphasize enough, this is a very important first step in giving us this small open economy model, production-based, that is matching the data and has these features. So also, so in this model, only households can borrow from abroad. So our firms, they borrowed from domestic households, right? But they cannot borrow from abroad. And I wonder, how would we interpret this and what the consequences are? I mean, in some sense, you have the household serving as a financial intermediary for the foreign financing of the firm, right? This probably simplifies the analysis, right? But it also, conflates sort of some of the household's incentives with the frictions that firms facing an international financial market to fund itself would face. Perhaps this would endogenize the connection between these domestic and external credit conditions that showed up then per assumption in the shock processes. Although then maybe this correlation might become positive, right? As domestic credit conditions crumble, then so too is the access of firms to credit markets abroad, right? We think of, twin crises but I'm not sure. But this is just something to think about. Then the utility kernel. So there was this C tilde that showed up on a slides brief. I don't know if the rest of the participants saw this. This was a CS aggregator that combines consumption per se and labor or leisure here augmented then by productivity in order to achieve stationarity. Now, this is certainly not the first paper, and if I look back at a co-author of yours paper, this is something that I spent a lot of time thinking about and playing around with, and I wondered really what is the effect here, especially because the way you parameterize the model, this elasticity is such that your bundle is multiplicative, so you do not need to add in this productivity process for stationarity, right? So that argument falls out the window. But it also makes it a little easier to see what's going on. So if we redefine this consumption bundle as simply the product of consumption and leisure with these two different weights, we see the effect of adding in this adjustment for the standard of living, and it's giving something that you might be able to interpret as a preference or valuation shock that's correlated, right here, obviously 1-for-1 with productivity growth. And I wonder, right, so it's off by 1 period, right? It's current growth and not expected, or not next period's growth. But nonetheless, this cannot be entirely innocuous. And it's certainly something, looking at Max's model, when I've played around with different utility kernels, that CES sort of combination thing, I think gives you a little more oomph than one might suspect at first glance and that one might really want to see. But why is this a problem? If we just look at the way the utility kernel is set up, if you have an adjustment here for productivity, we have no more leisure, no more consumption, none of the risks has changed, but agents are better off. They have more utils, right? Is this an adjustment for the standard of living? That's what your co-author said 6 years ago. But maybe you could think about looking at a different utility kernel in there, because that shouldn't be, if that's important for your results, then you should mention it. If it's not, then you could look at something that already has stationarizable form with it. Right? The literature knows how to do this. The impulse responses you give us, I'm not sure what they were. The structural model is nonlinear. There's no unique definition of impulse response. And going through the paper, I couldn't find anything. Could just find as deviations from steady state. You mentioned the steady state before. What is the steady state here? Is this a deterministic steady state? Is this a stochastic steady state? Stochastic steady state is a very, philosophical term, the rest point to which the economy comes when no shocks materialize, but agents are afraid of future shocks. So why not do something like deviations from the ergodic mean? Right, this literature has been discussed greatly in the DSGE model literature.
That's
Five, yeah. But at very least, I'd like to hear what you actually did, and maybe you could discuss that also in the paper so that the readers know what you mean by an impulse response. How's this object defined? Obviously, in a linear framework, we don't need to talk about it, but in a nonlinear structural model, there are different ways to do this. All right, so give me extensive work, and you did a great job mentioning this, harmonizing this fantastic data set. Why don't you estimate the model? I don't need to talk about this anymore because obviously that's on your list, as you mentioned. I will point out, so in work that I've done in macrofinance model, we sometimes have a difficulty at matching things like an average risk premium that we think is important when we only have one observation, as it were, over the sample of this one average. And I found endogenous prior methods from Delnager and Schorfheide to be very, very useful, sort of balancing likelihood-based information with a pseudo-calibration to push the model still into actually caring about this one moment that we find particularly important. Okay, exchange rates also, so as you mentioned, you can shut down the open economy part of the model just by turning off debt, right? There's no role for trade here. There's no role for prices, or changes in exchange rates. Perhaps if we have nominal indebtedness abroad denominated in foreign countries' currency or the rest of the world currency or whatnot, and how these financing conditions might change because of that. But I'm sure this is, something you thought about. But again, right? So as the step here, giving us a small open economy model that matches these international financial facts in a production-based setup, taking components that we're all familiar with, sort of out of the box and just putting them together in the right spots is already a fantastic contribution, which is why I conclude that this is a great paper and it is a big step. So that's it from me.
Thank you very much, Alexander. Questions from the audience, comments?
I have a question, or more a comment rather than a question. So you were mentioning that your empirical results that external credit shocks drive long run or expected growth is novel, or I'm not so sure about that, or perhaps you could link this to the general literature that we have about leverage cycles, about financial stability conditions, where exactly credit supply shocks somehow, there is a big literature on exactly this, like financial cycles that somehow lead to low growth or larger tail risk for growth, or and why I'm mentioning this is because here at the Bundesbank we always have these conversations with our financial stability departments about the financial crisis and how we can think about this. In Germany, I mean, Germany is perhaps not a prime example of a small open economy, but still. So what I hear from these guys is always that this was sort of like an imported crisis. Okay, so the credit shock was somewhere in the US, and if you just run these models with German data, you have a hard time matching what happened here in 2008 and 2009. You need this external shock somehow, and I'm not sure if the empirical literature in that area has done this internationally or has taken these, like, say, these regressions of growth on financial stability variables also to an international level. But so that's certainly something where you could make a contribution.
Yeah, thank you for that comment. And yeah, so I think maybe you know, in terms of my wording, I think the co-skewness result, I think, is one that we definitely believe is unique. But as far as linking our result just regarding external credit conditions affecting long-run growth, I agree that I think we could link it to this established literature because, yeah, no, I think that's a fair point.
So I have a quick question. Should I go ahead?
Sure.
Yeah, so when you add jump to your model, you are able to match the data. So, and you match also the co-skewness, right? Adding jump implies that many variables in your model will also be skewed and will have fat tails, right? So when you get into matching quantities, did you try to also match all 4 moments of all variables that are skewed because of this additional assumption of, you know, jump? So because what you just showed us is just the co-skewness, right? I believe that there are many other variables that you should check as well, because this is more like a new dimension you are bringing in, right? To, you know, to explain what you want. And I think it's also be grateful to also look at, it's not just about all 4 moments. These variables also exhibit, like, there is a dependence between them. When you talk about co-skewness, you should also think about co-kurtosis. And, you know, there are many things going on over there, so that you should check as well to make sure that you can match. I believe that you would match them probably, you know. So, but it would be nice to see a discussion about that as well. So that's, I think that's my question.
Yeah, so I think, as you noted in the presentation, we do focus on at least saying that, okay, we add this kind of common tail event, and this allows us to match the co-skewness in the data. But I guess one thing I want to emphasize there in regards to your comment about, you know, matching kind of other skewness of other variables or kind of other higher moments, is that actually we find by adding that one shock in, it's most of our moments are actually really not affected relative to the baseline case, and thus I think we view this as kind of a simple way to add co-skewness between these shocks that has effect on certain key variables, but at least doesn't seem to have strong effects on kind of other moments of our model variables. But I think we can certainly check and make sure, or at least see if this affects higher moments of other key variables as well.
Okay, thank you.
Further questions, comments? Sam, you want to say something related to Alexander's discussion, or?
Yeah, definitely. I mean, first of all, just thank you for, you know, great discussion with, you know, many great points and many I think helpful things to think about, as well as, you know, nice comments about the paper itself, which we certainly appreciate. Just kind of a few things I was writing down as I was listening to your discussion, your point about the composition of countries and ways to potentially explore results within that set. Well, we do plan to explore more about the kind of cross-country heterogeneity within our set, which would also, I think, include potential grouping of subsets, things like Euro versus non-Euro countries. your points about the structural mechanism behind the external financing shocks. So, we do not have a purely structural mechanism yet. In our VAR approach, we identify external shocks orthogonal to internal credit shocks. And I think your intuition is right on about some of the specific points you made. But one thing I wanted to mention is that actually, within the model, most of the action is coming from the orthogonalized external shock. So we do build in those correlations, but still there's a large degree of the action just comes from the orthogonalized external shock. And I think this is something that we can be more clear about within the paper. As far as households being able to borrow from abroad, or that's how we choose to model it, thanks for this point. I agree it's something we can explore further. You certainly, as you alluded to, you can think about it like the households and corporations are accessing external markets through the same intermediaries, which we're basically modeling with the same reduced form friction as this, external, the endogenous part of this external cost of capital. In principle, big corporations may access directly external markets, and they face financial frictions that may be different. And this is just something that's not in the model yet, but it's something that we plan to work on. And as I mentioned at the end of my presentation, at this point we've definitely spent, or we're kind of focusing more on understanding the composition of external liabilities. But I think it's still an interesting angle that we can work on in the future. The elasticity of the consumption bundle comment, I think actually there I have a good answer, which is that I think that's actually not a big issue, because the way we calibrate it, those shocks effectively have no effect. So we basically mimic a deterministic trend. It's like it's just a really smooth moving average process. The impulse response function question, certainly can be more clear in the paper if it's not, and to answer your question, we solve the model with the second order perturbation method, and the impulse response functions are based around the stochastic steady state. And so specifically, so you compute the projected path with the shock minus the projected path absent the shock, and thus we can consider non-stationary variables as well. And then, as far as estimating model, certainly we're right on board with you that that's something that we think is important. So,
sorry, Sam, can I just step in? I just realized that Alex, first of all, thank you very much for your discussion. I think we have many typos in the version of the paper still. So it's totally true what you said about the standard of living as you showed in your slide. Probably it's just copied and pasted from our paper. I agree 100% with your statements that it's not innocuous. And that's why when we wrote a follow-up paper with Ricardo and other two co-authors, the PKK, the easy way, we adopted a different formulation of the standard of living. So that it is, as Sam was saying, supposed to mimic almost a linear trend. It's not a linear trend because everything is co-integrated. Your comment is well taken. That's one of the ongoing all typos. But says so. Thank you very much. I'm gonna now.
Yeah, we'll certainly fix that notation, because I agree. I think in your slide as well, the way it's written is not clear. So. Or it's incorrect, actually. So yeah, we can fix that. Okay, so I think those were kind of the main comments, or the main things I wanted to make sure I could respond to. But I look forward to perhaps talking more in the future during the breaks. And thanks again for a great discussion.